Thank you for joining our webinar today. My name is Tony Wong, founder of Hong Kong ESG Reporting Awards Limited. It is a non-profit initiative aiming to promote industry best practices in ESG disclosure in Greater China region. The awards has been organized for 4 years in a row now. This year, we have received broader support from the Environment Bureau and the Financial Services Development Council of the Hong Kong government have joined us as supporting partners. We are also committed to building up a community and organizing webinars like this, bringing together industry experts to share the latest insights on ESG topics. Today, we are honored to have 3 gentlemen joining us. They are Mervyn Tang, Senior Director and Global Head in ESG Research, Sustainable Finance of Fitch Ratings, Sean Kidney, CEO of Climate Bonds Initiative, Neil Mascarenhas, Fund Manager of Hammond Investment Group. Without further ado, I will pass the time over to Neil.
Hi. Yeah, let me just start off with my. Okay, can you all see my screen? Yes? Okay, great. Thank you, Tony, for the kind introduction, and Alaya for the opportunity to speak to the audience. And good afternoon, everybody. I'm Neil Mascarenhas, a fund manager with the Hammond Investment Group. I'm also the ESG specialist there. To introduce my firm, the Hammond Investment Group is in Asia and emerging markets fund manager, founded in Hong Kong in 1989. Some of our strategies are the Asia ex-Japan ESG focus strategy. We have a managed accounts business, which are absolute return multi-asset funds for corporates and family offices, and alternatives in private equity, in new economy, China tech, regional property, and a leveraged global high yield fund managed along with 2 partners in Hong Kong. We are also a member of the TCFD, the Asian Investor Group for Climate Change, which does some great work in Asia. We are a signatory to the UN Global Compact, as well as part of Climate Action 100, which engages the largest greenhouse gas emitters and focuses people on net zero. So before we get on to the bigger picture, I'd like to start a bit micro to start off with, about the ESG strategy we developed at Hammond and the key findings within our portfolio. So we first started exploring ESG over 3 years ago, when we understood that much of the risks that were impacting our portfolios were really governance, social related risks, and other non-financial risks. So at the time, there was a growing awareness in Asia around ESG and climate related risks. And we looked more at the ESG factors across organizations like SASB and UNPRI to understand the materiality on our portfolio holdings. And initially, we tried to follow the European model, which looked more broadly at sustainably included ESG. It included, climate, carbon emission standards. We found that a little too rigid, especially on the exclusions part for Asia. And Asia had its own idiosyncrasies, for Guangxi and family-run businesses and a very low awareness of ESG, etc. So we developed our own framework, which used fundamental analysis of companies, selective screening. Sorry, I'll just go down here. Selective screening and qualitative analysis of ESG practices of companies. And a lot of these were very value judgments because we were active managers. And we also looked for an improvement in third-party ESG metrics over a period of time, as well as disclosures. But more importantly, what we focused on were the long-term sustainability goals towards 2025, 2030, and 2050 as part of the TCFD framework. So this totality was captured in our in-house Hammond ESG scorecard, which directed the company selection for our portfolios. Those companies that did not make the cutoff, we engaged with them and tried to build awareness and at least the need to have the minimum basic data to further our sustainability agenda and what we expect in terms of goals. And we also recently started to measure the carbon footprint of our portfolios with the aim to keep the carbon footprint and returns below that of the benchmark. So we ran this ESG framework for the last 2 years on our equity portfolios, and mid last year converted one of our funds, which was a UCITS fund, to an ESG strategy under the light green Article 8 of SFDR. Currently, the fund is in the approvals process at the Hong Kong SFC. So on the credit side, we were very ambivalent about sustainability bonds in the beginning and green issues, as there wasn't enough, enough on pricing. They were very, very low yielding because I think a bulk of them used to be from Korea, and very few protections. And the end use did not really distinguish them away from other cash bonds in the market at the time. So we opted to instead follow a complementary approach, which was working with an ESG overlay on our portfolios. So when we implemented this ESG framework on our absolute return bond allocations, these were some of the findings we had. One, we had a greater ESG impact where there was more idiosyncratic risk. That means we saw a far more positive impact of our ESG framework within the high yield buckets. That's the single B and the double B rated buckets rather than investment grade. I think most of this was really because on the investment grade side, you were really focused on duration, credit risk, whereas high yield had more bond specific company risk because it was more correlated with equity. And we noticed that the higher the rating, there was a definite correlation between ESG ratings and bond ratings. So we had a greater impact on the high yield side. The second thing was when implementing the framework, we noticed the universe of names really shrunk down, and there was a higher liquidity impact because some of the newer issuers, say over 2018-19, actually had far more information and details when compared to the older issuers in the past. And even issuers out of Indonesia and India were not really ESG friendly and not attractive in terms of yield too. The composition of the market also shifted much more in the high yield space towards the China property companies. We saw a better return from the portfolios with the ESG overlay. So the alpha difference between the portfolios, they were both absolute return portfolios. The alpha difference over 18-19 was about 1.5%. And for 19-20 was close to 85 bips. And the difference between the two was we excluded names in polluting sectors and the high carbon emitting companies. We kept smaller weights for the companies which had ESG controversies and other ESG issues. And also we higher duration for those ESG names we thought were pretty good. But what was more interesting and what we found to be the most important was that governance was really influential and material on the portfolio and not the environmental or social factors. So some of the factors we looked at over here were promoter, family support, etc. And if you look towards the passive strategies as well in the ESG side, this is some work done by IHS Markit, where they have applied an ESG framework based on the MSCI to their standard Asia ex-Japan benchmark. If they did a standard ESG screen, you saw that just about 47% of the entire benchmark was included. Whereas if they did a combination of screen and tilt, where they didn't exclude as much, just a few, but weighted the good ESG more and the poor ESG less, 94% was included. But they also found that the entire index was then heavily biased towards large investment grade names. And on an annualized return basis, they too saw a better return on the screen and tilt with lower volatility over a period of time. So while both these strategies are relevant, right, and at the moment complementary to pure sustainability bonds, one of the risks we will see going in this new climate focused environment is that much more is required on specific green attributes, which will be based on UN SDGs and ICMA, basically climate considerations. And especially with clients, right? You're seeing that it's not enough anymore to just say ESG is part of the process and okay, we'll sell out brown and take in green. Now they really want to see actual impact and how we are engaging companies to meet whatever goals we've set out for ourselves. And then, yeah, so I think this wraps up what I have to say. Thanks. I'll pass it on to Sean.
Okay, I've got a PowerPoint to share too. I think, Neil, you need to...
Stop sharing.
Thanks for the opportunity to speak, Tony. I'll just dive in. I'm here because, sorry, Tony, go ahead. I'm here to talk about green bonds, but more importantly, about risk associated with climate change, which is underpinning what is a growth of specific instruments that were relevant to climate change, which is around green bonds. Not always climate change. China, mainland China, for example, is the world's second largest market for green bonds. It started as a market focused on domestic environmental issues, air pollution, water pollution, and so on, with the climate change focus. As it's moved in the last few years, it now has a much stronger focus on climate solutions, and there's a harmonization with global approaches in this area. So that's a caveat. But largely, we've seen the growth of a large market of green financial instruments. And they're the daughters of green financial instruments using the same idea: social bonds, sustainability bonds, blue bonds, transition bonds, resilience bonds, and so on. Think of these as different flavors of ice cream. It's all ice cream. It's all about doing well by doing good. Note I mentioned doing well, which is a critical feature of this market. We've heard Neil talk about it in the equity space. In the bond space, we now have, as the market has grown, some very interesting characteristics going here. Now, I want to stress that these are characteristics, they are not drivers. So in the green bond market, in liquid currencies, we see price differentiation occurring. Why? Because in secondary markets, we see substantial premiums. You know, substantial, I'm talking about 5 to 15 basis points, not 500 basis points, so it's all relative. But green bonds are a premium product, at least in the key currencies, US dollars, euros, even AUD and the Chilean pesos. They attract a differential rate. They're a premium product. So if you're a portfolio manager holding green bonds in your portfolio, they're actually worth more. Now, not sure whether this next factor is cause or effect, but what we see happening in downturns, according to very interesting research by Jason Mortimer at Nomura Research in Tokyo, is green bonds hold their value. So while other bonds go into a pit when the past president of the US would send out a crazy tweet, the green bonds would hold their value. In other words, they're a capital retention. They become a capital retention vehicle. We can discuss why. I'm just going, and I'll tell a bit more about that in a minute. But the point is, that's the characteristics appearing. As a result, we premium product and secondary, downward pressure on primary. So we see attractive pricing appearing for primary issuers in major currencies. In China, it's a bit uncertain because underpinning the Chinese green bond market is a powerful incentive of the central bank, which is discount capital at the liquidity lending window of the central bank if banks post green bonds as collateral. They hold those green bonds. They want that collateral benefit. So you don't get the same market benefits appearing yet, as far as we can see, but we'll be doing some pricing research into renminbi green bonds in the later on this year. So we have investors appearing in this market because of capital protection characteristics. We have the taxonomy or definitions in China called the Green Projects Catalogue, which defines what can be in this market, beginning to represent a more valuable market, not a less valuable market. When I started working in this space 10 years ago, investors directly say, well, this is really good, this green stuff, but I've got to take a hit, haven't I? You know, solar stocks, they're volatile or whatever. This has now changed. Now we have investors saying, oh, if it's in the green space, it's lower risk. Less risk of policy action, less risk of climate change impact, and better value in secondary market. What's not to like? This is what's happening for this particular market. We have about 1.7 trillion US of sustainable bonds outstanding globally at the moment. This year, in 2021 alone, we expect to see 1 trillion US of issuance, at least according to a report by Standard & Poor's, one of Mervyn's best friends recently. So we have this extraordinary growth of the market. Now, it's only a small percentage. Global bonds outstanding are about 100 trillion. but it is rising with a bullet. And if you exclude sovereigns, 55% of all bonds are sovereigns, in the 45% mark, that's about 1.6 trillion of $45 trillion market. This is becoming material. And of course, the sovereigns from a very low base are now growing really rapidly. We have a whole lot of issuers in the sovereign green bond space, Germany, Italy, and Indonesia, and some coming to market. The UK is coming to market, 15 billion sterling program in the next couple of months. The European Commission is coming to market over the next 18 months with 225 billion euros of green bonds. This is going to grow. The sovereign slice is going to be the fastest growing sector. Okay, that's the background. What in the world is going on here? It's an appreciation of risk, fundamentally, that's underpinning the appetite amongst investors. This is actually a presentation I borrowed from the Bank of International Settlements, Financial Stability Institute. It's not mine. Central bankers in the Network for Greening the Financial System, an association of 90 central banks in the world, are now examining forward risks to financial stability as a result of climate change. Physical risks, PG&E going bankrupt in California as a result of wildfires linked to climate change is a material risk to the financial system. Reinsurance in Florida, all the reinsurance companies withdrawn, leaving the state exposed. Mar-a-Lago, President Trump's house, is reinsured by the state, not a commercial, because they won't touch it. They consider low-lying land and a hurricane zone too high a risk, and so on. There's a whole bunch of physical risks which are becoming real. Transition risk. In 2001, the German government used the feed-in tariff. That started a dramatic reduction in cost curve for solar and wind because the volume purchasing. The Chinese government picked this up in 2006 with one of the largest solar and renewable energy purchasing programs in history, which has driven down the cost. Everyone else in the world is now getting unbelievably cheap solar and wind as a result of state action to deal with environmental issues. There are many areas where this is happening. Electric vehicles driven by China. We'll see any company, auto company, that is not moving to become an electric vehicle company go bust. I'm predicting within 10 years. But hey, that's Mervyn's job to make a proper prediction. So we have at least material risk beginning to appear here. And then there are other risks as well. So the developments we've seen, I've mentioned the association of 90 central banks, including the US Fed, looking at forward risk on the basis the past can be no guide to the future. So in June last year, they published scenarios for reviewing regulation in this area in the context of trying to mitigate forward instability. This is a real lesson for rating agencies who are using backward-looking models to assess risk in a time when we're going to see a lot of change going forward, and we don't have the models to properly assess that risk. Regulatory action is becoming the norm, driven to a certain degree by the increased commitments by governments. At the Biden Climate Summit just recently, we saw Japan, Europe, and the US and many other economies commit to 2030 targets in the order of 50% reduction in emissions. These are tough, these are serious, and these will have palpable impacts that we're still figuring out on the economy, but they'll happen sooner rather than later. The risk involved. And then, of course, I mentioned past state action as an exemplar of risk. Think of what's going to happen with gas. Green hydrogen is now becoming a policy priority for member states. This is hydrogen generated from renewable energy. The price curve of that is going to match solar. In 10 years, we expect it to be cheaper than natural gas. When green hydrogen is cheaper than natural gas, with all the license to operate and opprobrium attached to natural gas, what are people going to do? Which are they going to buy? Realistically, they're going to shift to green hydrogen. That at least introduces material risk for gas investments. Make your money in the next 6 years and then try and get out, would be my advice to gas investors. And don't think that a 30-year contract is necessarily going to protect you. So we've got some material risks appearing in the system which underpin this whole green finance measure. This year, it'll all be about what is green, the European taxonomy, the Chinese taxonomy, and the the People's Bank of China announced its upgraded taxonomy on the same day as the Europeans deliberately, because we're working together to harmonize and we want to let the US know, by the way, guys, there's a job going on out there. Supportive measures, as we've already seen in China, and we're now seeing in Europe, green quantitative easing. And a green window will be a feature this year, while we will continue to see vicious competition between China, the US, and Europe at a higher level. We are already seeing the beginning of a green carve-out. For climate change issues, they will collaborate. We think there is a great opportunity to introduce a new innovation. Think of this as zero tariffs for zero carbon steel, etc., etc., etc. That will become a feature of this year. Well, look, there's a reasonable chance it'll happen. So for Neil's perspective, he has to factor in the risks of this happening when he's thinking about forward investments. It's become material, folks. It is no longer an abstract idea. And that's why green finance is booming.
Thank you, Sean. Mervyn, pass it over to you.
Great. I have the pleasure of finishing things off with Neil and Sean having spoken. So let me share my screen. Oh, sorry, closed it by accident. Very. There we go. So following up from Neil and Sean, absolutely agree that climate risk is increasing, both on the transition and physical risk side. And I think that's both in terms of just the environmental consequences of climate change, as well as the regulatory impetus that we've seen across economies. Now, the question is, how do we fit this into credit risk and credit rating analysis? How does that link to green bonds and kind of the more over the evolution of the sustainable finance business and industry? Now, when we're thinking about, I think it's worth differentiating credit risk at the issuer level and then green bonds as an instrument versus conventional bonds, and then the market risk that kind of we've been talking about. Because if we talk about a specific issuer, let's say something like Volkswagen issues a green bond and a conventional bond. The differentiation between the green bond and the conventional bond is the use of proceeds. So whether it's a sustainable activity that the green bond is being invested in. So the proceeds is tied to a specific project, maybe let's say the development of electric vehicles. Now, the green bond and the conventional bond would have the same credit risks, because in the event of Volkswagen defaulting, there is no specific, like the instrument that is, what backs up the cash flow of the green bond instrument is no different to the conventional bond. So when we're talking about the credit risk side of things, the green and the conventional bond from the same issuer is the same. Now, there's market risk differences, of course, which Sean mentioned. So there is a different supply and demand dynamic to green bonds. There does seem to be this extra bid because of dedicated green bond investors and ESG investors wishing to invest in green bond, which changes that market dynamics. And I think in the past, it's not been easy to really differentiate that greenium, so to speak, until now, where we've seen some innovation. So Sean mentioned the sovereign bond issuance, the German twinned green issuance. I think it's a very good example where you've got a green bond and a conventional bond with exactly the same financial features. So duration, maturity, interest payments, all this is the same and it's linked to the same issuer. The structures are the same. The only difference is the green element and the use of proceeds. And we're seeing that green greenium expand over time, or actually in Q1 in particular. So that's already this example that there is this market demand for green instruments. But if we're talking about the credit risk of the green bond universe versus the conventional bond universe, then there is a difference in the asset mix and the issuer mix of these universes. In conventional bonds, particularly bond indexes, there is a huge amount of oil and gas, natural resources issuance that are tied to fossil fuels. Green bonds, by definition, you've got a larger share of issuers which are issuing in renewable energy, in sustainable transport, lots of sustainable use of proceeds. And so this means that the issuer profile of green bonds could mean that you have you have an overall universe that is less exposed to the environmental risks that Sean mentioned. Now, when we're thinking about this, and we've been asked this by everyone just because of the booming interest in ESG, is how do we then fit the credit risk analysis with the ESG analysis? And I think the key is trying to understand the transmission channels of these risks. Sean mentioned the regulatory side, and absolutely we're seeing that. EU ETS, the launch of the China emission trading system, Biden administration's new administrative orders, lots of things happening. There's still this gap between what governments are saying they will do and the current policy environment that they have, so that there needs to be kind of a way of bridging that gap. But it does mean that you have this regulatory gap risk in the future, particularly when we start having the Paris Agreement ratchet mechanisms, those agreements. It may be the world finds it very quickly that to do what they say what they got to do, carbon pricing regulation has to tighten very quickly. There's also not, the regulation isn't the only thing though. So we've seen, let's say, examples of financing constraints because of the way banks and asset managers are ESG and climate. So we're seeing more and more of those financial institutions saying, we don't want to invest in or lend to coal anymore. And so the companies that are exposed to coal and no longer receiving that financing, we've seen examples of downgrades in that area. Now, we've got to be careful though, because when we comment credit risk, a company's or an entity's credit profile is not just related to its ESG risk exposure, it's to do with its overall exposure. So the reason why we downgraded, say, an Australian coal port terminal is because not only were banks and asset managers pulling away, they also had a bullet amortization debt structure. So they were coming into the market every 5 years with a huge chunk of debt. And so the financing constraint is magnified by the ESG risk that they're facing. But if we think about, let's say, an Indonesian SOE, and until regulations come in, those SOEs, even if it's a coal SOEs, the financing constraint is not the same because quite often there's, say, domestic banks and domestic state direct funding. And so if we're thinking about the financing risk, that might not be the main concern from a climate perspective. There is bigger concerns when it comes to the market for global energy, whether people are willing to pay the same, and the energy economics that Sean mentioned. But when we're thinking about the transmission channel, it's not going to be the same for every entity. Similarly, with the emission trading system, what we found in Europe was, depending on the market structure of the utility that was being affected by the ETS, their ability to pass on those costs varied depending on how regulated the pricing structure is. So in a world where the costs, where the pricing mechanism is effectively set by the government, those carbon costs often pass through straight to the customer. And the overall evolution in terms of greening strategy for those entities was a direction that they were moving, but it wasn't necessarily translating to credit risk. So a lot of nuances there. So to break through that nuance, we got our analysts to start assigning the ESG relevance scores, which are scores of 1 to 5 that indicate how relevant or material different ESG issues would be. So if we take climate, greenhouse gas emissions and air quality, if it's something that's absolutely changing their credit rating by itself, so a VW emission scandal, or for some coal entities that are really struggling to operate. That's a 5 because that issue by itself is affecting the credit rating. A 4 means that the issue is starting and having an impact on our credit metrics. So it might be profitability, it might be financing structure, it might be brand positioning. There is something impacting our credit assessment, but it's not by itself changing our entire credit rating decision. So if you take an automobile sector, most sectors are, most entities in that sector are seeing 4s because the shift to EVs is a fundamental shift in the strategies of companies. And so if we take something like various high yield automobiles, the amount of cash flow that you need to invest in EV production technology, R&D, it's a big amount, and it's really affecting kind of how we see the broad cash flows. A 3 means that the issue is probably relevant, and there you can see the transmission channels, but it's being managed in a way, or the regulations aren't quite there to be impacting the credit assessment. A 1 and 2 means that it's irrelevant to the specific entity. A 2 means that it affects some of the peers in the sector, but a 1 means that it's not relevant to the sector. So we set out this mechanism as a way of systemically addressing some of these ESG issues. And we're learning at the same time. So Sean mentioned, there's a lot of backward-looking models. It's true. Climate change, a lot of these developments are not seen before. It's forward-looking. It requires scenario analysis and all kinds of assumptions on technological evolution, how we see battery storage moving, how we see hydrogen, so many things to consider from a risk analysis perspective. But here's just some examples of the 4s and 5s that we're starting to see. A 4, so Jaguar Land Rover is an interesting one because their product portfolio is weighted towards less fuel efficient SUVs. They are also a kind of cash flow challenged entity. And so the fact that they are investing so much to try and make this shift is making it more difficult for them to manage their kind of cash position. And again, this is affecting our analysts' assessment of the overall credit. ESG doesn't have to be a negative risk, it can be a positive, like opportunities are abound. And so we also have this relevance scores for positive. And so Enelspa is a good example, where the fact that they've made strategic choices to invest heavily in renewables means that that shift is having a benefit for assessment of their overall business environment and their kind of exposure to some of the risks that utilities are facing. And so kind of getting ahead, that strategic element is an important part of our analysis. And I mentioned kind of one of the Australian coal terminals, the Adani Abbott Point Terminal has a 5 because, although we have this under management strategy, because they have such a bullet and monetization debt structure that even any refinancing risk, particularly, but this one triggered by coal, is having an impact on our analysis. Now, Neil mentioned that governance is the most impactful risk from their assessment. And for credit ratings, that is true. And I think that's because governance has always been part of credit rating assessment, even before ESG acronym is well used. Governance is really something that's influencing credit ratings across a huge range of sectors. And so the chart on your left shows you the percentage of issuers with at least 1 G score, 1 S score, 1 E score of 4 or 5. And the governance thing is kind of prevalent across a range of sectors, but environmental social risks vary a bit more. So clearly utilities and natural resources and industrial transportation, because they're vulnerable to those emission regulations I mentioned because of their higher carbon density, they are going to be more exposed to E risks. So so the left shows you the absolute distribution of scores. Interestingly, on the S risks, it's more to do with, let's say, social attitudes of, let's say, retail, consumer, and healthcare sector. So one example would be people are concerned more and more about the affordability of drugs. This is leading to a regulatory response on capping pricing, particularly in developed markets. And so the way that regulation is coming through, it means that a lot of the pharmaceutical sector is having a pricing cap and pressure on their activities. If we're talking about changes in score, though, G is the most dynamic factor. Utilities, even though they are kind of more exposed to environmental risks on the left, as you see, the changes haven't been as much. We're seeing more changes on the industrial and transportation side. And I think that's because we've seen the EU ETS and other carbon pricing schemes increasingly applied to the industrial sector. So steel, cement, fertilizers, cement, all those sectors are being more affected by environmental regulations. So it's important to look at the absolute as well as the dynamic changes. I'll just show one more slide on terms of region, particularly given that we're in Asia. Emerging market and developed market governance risks are different, although EM risks in governance risks are unsurprisingly higher. Governance risks in EM focus more towards things like concentrated ownership, so family ownership, it could be state ownership, it could be a variety of things, or lack of financial transparency. In developed markets, the governance risks are more tied to complex group structures and multinationals, tax considerations, and things like related party transactions. In developed markets, the social risks are higher. And I think that's because when there's a populist consideration, so for example, affordability of drugs, obesity, the health impacts of tobacco, developed markets are much quicker to come in with regulation impacting our analysis. Whereas in emerging markets, when there is social issues, it tends to materialize in terms of governance unrest, more civil, those sort of issues. When it comes to Europe, I mentioned where the emission trading scheme is strongest and carbon regulation is tightest, that's the reason why environmental risks are higher in that region. Asia is on the path towards the carbon transition, but when we're thinking about credit risks and this on the credit rating level, the forecast horizon is typically 3 to 5 years. And so the dynamic shift to incorporate some of those regulatory changes that we're seeing in the horizon is slower. That's not to say those regulations aren't coming, but the time frame is important from a credit perspective. On the right, there's not too much to say apart from just the fact, even though in Europe that it's emission trading is the scheme is the strongest, it's also tightening quicker. So we've seen the EU ETS carbon price shoot over 50 euros a ton now. That seems to be going up, and people are really trying to prepare for this new tightening environment, particularly with allowances coming down and sectors and these sector applications and the sector coverage widening. So a lot of things developing. So we have plenty to talk about, and it keeps me, Sean, and Neil very busy. I'll stop sharing now and pass it back to you, Tony.
Thank you, Mervyn. Well, thank you, the three gentlemen sharing the key trends in the industry. Like what Sean mentioned, major economies have made their commitments going for net zero, and we've seen a lot of regulatory changes coming up. So, what sort of challenges the three of you envisage in your own industry, from Neil from a financial or investment instrument perspective, or Mervyn credit rating perspective, and Sean from the green bond perspective? We've seen the number of green bonds this year is off the chart, but what sort of challenges we'll be seeing? Neil, would you go first?
Yeah, so I think for us, I think policy is moving too soon. Without really considering some of the repercussions on the investors and clients and companies themselves. If I were to use an analogy, the speed of regulation at the moment is like a bus moving too fast, and we're all running behind chasing it, right? You have almost 2,000 pieces right now of legislation and regulation and policy globally. I mean, people are still focused on Paris aligned, 1.5 to 2 degree scenario. And already we are moving to Glasgow and net zero, etc. And it's very tough for people to really keep up. And I think that bus, needs to slow down so that not only the large funds get on board, but also many of the smaller firms and even the smaller investors. And another thing you will see also is you have a lot of companies talking net zero, right? It's a very serious commitment. And while the trajectory of 2050 seems very far, when you go down into the nitty gritty, you're talking about a 95% You have to give a plan of 95% reduction of your scope 1 and scope 2 emissions, whether you choose the short term, medium term, and long term, right? And even relevant scope 3 emissions. So you can understand what impact this is going to have on the entire business model of a company. You know, what sort of margins can they expect going forward? I mean, future capex. What carbon levels are you going to talk about? Is the future capex going to be towards decarbonization? And what sort of products are they going to come out with? So I think right now it's still a very fluid situation and very tough. Then you have two lobbies, right? You've got the value creation lobby. Those are the investors who believe in value creation. And then you have those who are focused on the climate agenda and basically values-based investing. And the two don't really meet, and there's no real equilibrium between both. You even saw the CEO of Danone kicked out, right? He was one of the sustainability pioneers and leaders in the field. He came up with the whole carbon-based EPS and carbon-adjusted profitability, etc. But within 4 to 5 years of underperformance, I think the entire value creation lobby pushed him out, no matter what he had done, with scant regard to whatever he had accomplished on the sustainability side. Then there's also, as you brought up, Sean, about carbon offsets and carbon pricing. So this is going to have a very, very big impact. In some cases, when say the carbon prices were close to 35 to 40 euros a ton, profitability of companies, if on an adjusted basis, would have come down anywhere from 40 to 50%. Right? So, and this I'm talking about the large consumer firms. So just imagine what happens when you actually have to start implementing offsets. Will the incidence be on the customer? And so I think these are some of the big challenges we see going forward. It's also the mindset of investors, right? If we have such nationally led decarbonization targets, and the top companies in per country saying that they will follow net zero, then how will their financing happen, right? All their financing will have to be low carbon net zero type of financing. And that automatically will start to change how investors who invest in these instruments think, because that will slowly move away. It'll slowly say crowd out traditional methods of investing, right? It'll slowly crowd out traditional bonds. You'll start having a far, far larger piece of sustainability bonds, for that matter. You'll have to beef up your teams to be able to end use monitor, to be able to understand project finance, to be able to understand all the regulations, to see where, what sort of commitments are being met and what sort of targets are being met. So I think even investors are woefully prepared for this. Yeah.
Look, you're right, Neil, that things are really shifting fast. And it's a challenge to keep up with them. But is there any choice? This is the trouble. When you read the Intergovernmental Panel on Climate Change report, 1.5 degrees in 2018, huge, vast document. It's scary. It's like reading a horror thriller in terms of the impact on our societies and our economies going forward. And this is not linear change. This is volatile change we're going to get. Not just wildfires in California last year, but the pandemic, which is rooted in pathogens jumping between species as a result of degraded biodiversity, degraded environments linked to climate change. The IPCC Health Committee has been predicting pandemics of the 21st century for the last 30 years. It's no surprise to the health community. It's no surprise to the climate change community. It's just a surprise to leaders who chose not to bother to institute protection mechanisms and beef up the World Health Organization to prepare. And a couple of days ago, the World Health Organization review of the pandemic said all the things that were said in 2019, by the way, said them again. There are getting more of these and we need to prepare. These are material risks to the financial system and financial returns as a result of climate change and environmental change, which we have not been adequately addressing. And the clock is ticking, so we have to move fast. So it's tough, no doubt about it. The bus is moving quite fast, actually. And yes, a lot of us are behind running, saying, hey, God, wait for me. But there's no other choice, I'm going to say. The challenge now is to help everyone get on the bus as quickly as possible and whatever as quickly as possible. The Danone guy, oh, he was one of my heroes. But you still have to deliver results. He got knocked out because of a results equation. I'm going to argue that if we play this change right, we will deliver results. You will get alpha, which is what you're looking for. And it just is that to figure out alpha going forward, you have to do more than look at the last 10 years. You have to look at the coming wave of change. Now, this is no different to being in 1996 and having a crystal ball, seeing the internet. It's exactly the same idea, right? Coming wave of change, including, of course, the crash in 2000. We've got to understand the future. We need to understand factors. These are really material changes, including the policy-driven changes, which are going to be quite fast. So, of course, we have to get on top of it and try and predict and get the support of the Fitches of the world to try and figure out where that future is going so we can invest in property and get returns. Now, we will see, we are already seeing better returns in the select companies, but you've got to give deliver returns. You can't just deliver sustainability. And that's been a feature of the green bond market. It delivers both returns and sustainability. And that's the key point about this. Now, look, I'm a bond guy. It's simple in a way, you know, fixed income. I realize equity is far more complicated. That's your job, Neil. But the principle still applies, I'm going to argue. Everyone needs to understand this tsunami that is hitting our economies and prepare and recalibrate and develop expertise and capacity. Of course, at a regular level, we are working to try and make some of this stuff simpler. Not everyone is going to have to monitor end of use of proceeds stuff, because we're trying to institute regulatory oversight and all this sort of stuff, which will take the burden off investors, at least in terms of disclosures and discovery. And in Europe, you will note that the European taxonomy is linked to a disclosure regime which requires all investors, corporations, and banks to disclose annually their sustainability investments, as well as the high carbon investments, in a comparable fashion. And then you as an investor will be able to pick and choose between the corporate reporting to add that layer of understanding to your returns and risk understanding that you already have. So hopefully that'll make it easier. But all I'm going to say is, if you're not with the program, you are likely to be left behind the bus, way behind, as it takes off.
I maybe just add one thing, as Neil Sean covered so much already, but I think there's confusion on kind of two sides. There's one is the changing architecture of sustainable finance and ESG investing. And then you've got the changing policy perspectives on ESG issues like climate change, biodiversity. And I think they're worth distinguishing, although they're of course interrelated. And so with, I think, sustainable finance as a whole, there is this confusion now coming in. It's like, oh, what's an Article 6 fund? What's an Article 8, Article 9 fund? What is an ESG fund? Is it screening only, or is it like there's a tilt strategy, or am I having like an impact? And so there's a lot of terminology lingo that's coming in on the sustainable finance architecture. And I mean, the whole thing in all this is, I mean, there's a noble goal. It's to direct activity capital flow towards sustainable activities. But there's going to be a lot of confusion in a world where this is evolving so much. There's just like disclosure requirements, what to disclose, what exactly how to do it, lots of debate there. But when we're talking about climate policy, the need for carbon pricing, all that trading scheme, that's a much more economic, broader issue, right? It's a policy conversation where it's a conversation that, oh, you know what, if we don't do anything, the balance of physical risks or the potential for the severity and frequency of natural disasters, as well as long-term climate change, is going to have a negative impact on the world and could be a very negative impact. And so the question is then, okay, well, how does that policy evolve to change this? I think the biggest challenge for this is governments recognize that there's this longer term risk. And so they're saying, we will do net zero emission pledges by 2050, 2060, we'll cut emissions by this much. But the actual policies coming through to actually deliver that, we don't quite see it yet. And so the way that exactly the regulations and policies actually materialize is going to have a huge impact on our credit analysis. Because there's one thing saying you want to reach net zero, but net zero with offsets is a very, very different idea and change of structure. If we're saying net zero, let's have a low carbon transition with natural gas and without natural gas, the look of that time path to net zero is very different. And so all these things need to be considered. And then those policy factors are going to be influenced by the evolution of battery technology. If we suddenly get a breakthrough in batteries, then renewables as a baseload becomes a much more obvious choice, if not an obvious choice already. So there's all this stuff that can happen that we all need to understand, but this is beyond about the ESG investing in sustainable finance infrastructure. These are just big macro policy risks that we just have to incorporate, regardless of whether you're an ESG fund or non-ESG fund.
Agreed.
Right. Thank you, gentlemen. There's a question from the floor, and how can one keep track of carbon pricing, and how do the fluctuations affect your yields, your fields, or credit analysis? Anyone would like to take this?
Yeah, I think for credit analysis, so there's a lot of carbon pricing mechanisms coming through, right? So when we're talking about carbon pricing, a lot of different parts of the world, so China's had a pilot regional schemes for a long time now and just launched a national ETS. We have seen pilot schemes in Mexico. We've seen kind of individual states in the US, the EU ETS, probably the most established one. So there's a lot of different carbon prices operating in the world. Then you've also got voluntary carbon markets like offsets, which determine which people are investing in as part of their net zero pledges and carbon commitments. And so there's a lot of different markets, a lot of different pricings coming through. And then when we're thinking about impact on companies, it's also about ideas like free allowances. So you can look at a carbon prices, but then what are the allowances that a company has? How much can they, and then how much they can decarbonize if they don't want to pay for those allowances. So there's a difference between, let's say, a steel company which only has access to a grid which is just coal, and so its scope 2 is going to be heavily exposed to based on its region, versus a utility company which is now shifting its own investment from a coal mix to a renewable mix. There's kind of a lot of these implications from a credit risk perspective that is going to be driven by carbon prices. Now, like any market, it's going to be volatile, but one thing to think about with environmental risk is we're not thinking about short-term trading market fluctuations unless you're a carbon trader. It's about what this means for the energy economics transition, which is going to be gradually evolving from now to 2020 to 2050. Of course, it might be too quick for Neil and not quick enough for Sean, but there's going to be a debate. I think that's going to be ongoing. But yeah, we monitor carbon prices, but again, the short-term fluctuations isn't necessarily the key to understanding the credit risk issues.
Yeah, and also the CDP, they do some good work in this area, and according to the last statistic, I think there are close to 1,200 companies in the world currently which factor in these carbon numbers into their portfolios for a 2030 target. I mean, I think they assume that by 2030 they will have to actually show the differential, the price differential carbon mix on their earnings as such. So I think the CDP is a good place to start.
Okay, there's another question. I think from an SME. SME, can they play a role in supporting net zero goals? Can bond help?
Maybe I can just talk a little bit about that. Yes, I know. I think that's a very, very good point. Green finance and issuing bonds, SME should be one of the biggest beneficiaries really of this, because when you look at a traditional bond and you look at the end use, it's typically to refinance corporate indebtedness or to for general corporate purposes. But when you look at green bonds, they're typically geared to an end use. Green bonds didn't take off earlier in China because they had allowed a 50% leeway for that money to be used for any general corporate purpose. But I think now they've tightened up the rules and it has to be end use specific. So for an SME, right? They would be raising money for something very, very, for a project based, or for enhancing whatever whatever facilities they have, or bringing in a new piece of machinery, etc. So if they were to issue a green bond with a very specific end use, and they tie up with a monitoring agency, this would be fantastic for them. And I think the Hong Kong government also has, when they set up the green bond fund, they take care of the expenses for those smaller firms who would like to issue green instruments. I think the limit is about 2.5 million in terms of the expenses to raise green capital going forward. So the Hong Kong government does have some very interesting products for SMEs who would like to raise green finance, because this is absolutely geared towards them. Yeah.
I might just add one thing, is that, so we're seeing ESG and climate considerations spreading widely across the market. And I think one thing that is driving that is the ESG concept is being passed through a variety of structures. So structured finance, CLOs, leverage loans, banks, and green loans. And so, of course, in the financial markets, you have different types of instruments catering for different types of assets. So if you're a smaller entity that are unable to actually issue debt in the capital markets, you may go to just leverage loans or syndicated loans process. And so we're seeing more and more with the CLO structures and CLO providers, CLO investors considering climate and ESG. That is leading to the understanding and the reporting and disclosures and actions of companies that are operating and financing themselves in that space. Then you've got maybe even smaller companies which just take loans from banks. It's a more traditional method. And we're also seeing developments on the green loan side, right? So banks are desperate to make green loans, use those green loans and issue green bonds. And so we're seeing the financing channel where the green element and or ESG element as a whole trying to facilitate financing to those entities. So it may not be as established as green bonds, but we are seeing an evolution of the financial system, which is trying to cater to whatever part of the market needs it.
Yeah, thanks, Mervyn and Neil. Sean, there's a question for you. What sort of work does Climate Bond Initiative do with the Hong Kong Stock Exchange stage? And what can we expect in the future of green finance here in Hong Kong?
Well, we're very excited to have Hong Kong Stock Exchange as one of our Climate Bonds partners that we're working with. And we've got partners around the world that we're working with to grow sustainable finance flows. In Hong Kong, as you would know, under the Bond Connect, we're looking at a green carve-out and properly tagging in the Hong Kong listings those bonds in the Chinese green bond market that meet the international definitions, to make it easier for investors like Neil, on the fixed income side at least, to pick up bonds that they can repackage for investment by dentists in Belgium. So we've got that kind of role. We're also helping with a bunch of other initiatives. So you'll see a lot more coming out of the Hong Kong Stock Exchange around green finance. And I have to pay special tribute to Grace Sui, who's leading that work within the Hong Kong Stock Exchange, doing a fantastic job of getting that stuff together. Of course, it's worth noting that green finance in Hong Kong was really kicked off by the government and the Hong Kong Monetary Authority, where there's been a range of promotional measures and guidelines issued by the Monetary Authority and the various other institutions to try and grow green finance. And of course, then we've got the Hong Kong, what do we call this, semi-sovereign issuance? It's not a sovereign, but I mean the state issuance of green bonds, which has helped provide liquidity to the market and guidance. I mean, there have been other players. We've seen issuance by various property trusts in Hong Kong of green bonds. So there's a local market going as well. And of course, MTR, one of my favorite subway company in the whole world, because of their financing model, has been issuing green bonds. So there's quite a lot happening in Hong Kong related to this. There is a push behind this. But yeah, now Hong Kong Stock Exchange is doing really good work. So kind of watch this space, really, and watch this space for other initiatives. In the Greater Bay Area program, which of course Hong Kong is intimately plugged into, there's a number of initiatives we're pursuing about property-rated bonds, guidelines, working with the relevant government bodies in the area to grow green finance. It's very exciting in that area. Even Macau has got a program around green finance at the moment. So it's like, you know, it's going to be like snap, crackle, pop over the next 18 months of initiatives that you're going to hear about.
Thank you, Sean. One last question from the floor. Maybe we can still answer that. Hong Kong also has a carbon neutral strategy target, right? To get it done by 2050. So from a fixed income bond perspective, you know, what sort of things or steps or action or policies that, you know, you expect the government or the market should be doing in the coming years to meet that goal?
Well, this is tricky, this one. I'm an NGO, I can say this. Mervyn's got to be a bit careful, as is Neil. You know, there is no government in the world that's doing enough. No government in the world. And there are huge environmental challenges, climate change and related, that we kind of got to get on top of fast. So in Hong Kong, part of the sovereign bond program is going to wastewater treatment, for example, which, by the way, has a direct methane implication, which is a greenhouse gas going forward. Guys, what year is it now? 2021? This should have been done in 1999. This is ridiculous. Get our act together. Please do it fast. Clean up Hong Kong's water as part of it. I mean, the ocean here. But again, we can look at every different area in the building sector. Hong Kong's green building regulations need to be tougher. We need to have much more efficient, reduced, by the way, the energy costs for everyone in Hong Kong while we're at it. There's a direct material benefit for everyone. But, you know, we've done this already. Shenzhen has tougher green building regulation than Hong Kong has. This is absurd. There are things we've got to do. Now, don't get me wrong. There are people that are doing really good work. You know, Swire Corporation is doing some good work, for example, but we've got to do more. Ideally, we should be doing, I'm just going to give you on the energy side. There are 3 things we should do. All taxis in Hong Kong shift to electric immediately. There should be a leasing scheme that allows them to switch. That would be easy to do. That's been done in New York. Why are we still doing these dirty gas guzzler taxis? We can make it easy for the drivers to switch their vehicles over. 1. 2, tough building regulation, because the emissions from buildings are really important. 3, energy. Sorry, we should not be building new fossil fuel investments. CLP is wrong, in my view. We need to be shifting towards clean energy. And if that requires supporting the building of green energy on the mainland and bring that energy is, well, so be it. There is nothing wrong with that. Let's just do it and get on with it, instead of humming and hawing and saying, oh, we haven't got enough space for solar on the rooftops here. We'll have to build another gas plant. That is unfortunately not consistent with the targets we have never agreed to. We've got to be a lot tougher on what we're doing. But that doesn't just apply to Hong Kong. That applies to Singapore. That applies to China, Japan, the US, and EU. So it is a common problem. The good news is we've now got the targets. Hong Kong is committing to targets. We now need to figure out the policy that will properly get us there. As Mervyn was saying earlier, we are still figuring it out, but we need to do it. And really, that's this year. And that'll have an effect on investments, won't it? Neil's portfolio will be affected.
Right. Thanks, Sean, sharing your views. Any last wrap up from the gentleman, Mervyn, Neil?
Not from me. After Sean got the snap, crackle, pop, Rice Krispies quote in, I don't think I can follow that up.
Mervyn, any, yeah. Sorry.
Neil, you're on mute.
Neil, you're mute. Yeah.
No, I think that you know, it's going to be a tough landscape for everybody, for corporates, for investors, because you know, business models will change, and we need to understand. You know, you made a very good point about things happening very quickly, because when we do our models, right, we don't project, say, 10 years and 15 years and 20 years hence. So I think that's gonna be a sea change for everybody. So how they match policy to what's really happening on the ground, and that's going to be a very important thing going forward.
Tony, I'm going to finish up and say change is happening. It's not coming in the future. It's happening now. Get on top of it. It's going to affect everything. You've at least got to understand it. And if you're not understanding it, you're being negligent. You're missing a trick. You're missing an opportunity.
Yeah, I think the bus is moving fast after all. Yeah, so everybody has to take action. And yeah, I agree what you just mentioned about Hong Kong, you know, judging from myself live and raised here. So with that, thank you very much for joining us this afternoon.